Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Enlightened investors, what a delight to be back with you again today. Thank you so much for joining with us as we take a look at the important aspect of raising capital and managing our assets. Veena Jetti is the founding partner of Vive Funds, a firm that specializes in curating conservative opportunities for real estate investors. Veena brings a dynamic perspective to targeting, acquiring, managing, and operating assets using best practices combined with cutting-edge technologies. Her professional expertise includes driving corporate strategy and business development opportunities. Veena, thank you for being with us and share a memorable experience from your formative years that helped you to be who you are today.
Yes, thank you so much for having me. I'm so excited to be here. There are many. I had a very lovely childhood and upbringing. I was very lucky to have two very involved, hands-on parents, and I have a sister who is my best friend. She's actually my business partner at Vive too, as well. So it's really nice in that way. Well, and I think when I think back to my formative years, like my younger years when I was a kid, it naturally leads me to how I got to where I am today, which is buying large multifamily assets. And I actually come from a real estate family. So my mom is a very successful real estate investor. So there are many instances I remember of just being introduced to the world of real estate from a very young age. But one that was kind of a more interesting moment was I must have been like 13, 14 years old. And my parents made me read the book, The Millionaire Next Door, which at the time was really, really, really boring and very uninteresting for me to read. But what it did was, unbeknownst to me, because I begrudgingly read it. And, we would talk about finances, we would talk about money and real estate at the dinner table. It was never a taboo topic in our house to discuss. And I remember we would be talking about this book that I had to read and, on top of schoolwork, whatever. But what it really did was it created a foundation for who I wanted to be and what I wanted to be doing in my life, not just from a real estate perspective, but also where did I want to be on that? Did I want to be an overachiever of wealth? Did I want to be an underachiever of wealth? And those were things and concepts I was introduced to at a really young age.
Well, that is really interesting that even at 13 years of age, you were asking those big questions about wealth. Just thinking back to that Millionaire Next Door, you said it was very boring and you were very uninterested in it. What was the big lesson that, as you look back on it, what was the big lesson you took away from that at 13 years of age?
Oh gosh, probably that I always wanted to be someone who was overachieving. It's in my blood, it's in my personality to be like that. But I never wanted to be in a position where I couldn't afford to do the things that I wanted to do just because I wanted to do them. And so for me, money was a tool, right? It still is to me. It's just a tool. All it does is it gets me the thing I really care about, which is controlling my time. And for me, it's not enough for me to just control my own time. It also means that I want my husband's time to be free. I want us to be able to go on vacations, and I want to splurge and rent a yacht for the weekend, or whatever those things are. But those are things that I wanted to be able to do. And I knew that in order to get there, I'd have to have a very detail-oriented path to getting there.
Well, interesting indeed. We'd like to know how to get started here. So just take us down the path of how you got started. And yours may be very different from what most people have to begin with because, well, you had a map, essentially. You had a family who was already investing, which many of us have had not had that opportunity. But take us down the path of your start.
Yeah. So my parents are actually immigrants to the country. They came here with $26 in their pocket. I'm sure many immigrant children will tell you that this is the same story that their parents told them. But they came here to give my sister and I a better life. Like that, the opportunity was what they came to America for. And my dad came to do his PhD. He's always been a W-2 earner. So my dad traveled about 45 weeks out of the year growing up when I was young. So for about 30 years, he traveled most of the year. But my mom was the one who stayed home with us. And my mom is just a very ambitious person. She was not okay just being a stay-at-home mom and not contributing to the household financially. And it's just her personality and what her desire was. And so she said, okay, well, I'm going to figure out how to contribute to our family's wealth and well-being and future, et cetera. And in looking to how to do that, she's had many businesses, but her main focus was always investing in real estate because she understood the power of the tax efficiency behind real estate investments. And my dad, he did well. We were solidly middle class, but it was because of my mom that we were able to really build wealth for future generations, right? And so I started with a real estate family. My family always invested in single family. So my sister and I are the first in our families to be investing into multifamily assets. And the reason I got into multifamily is because that's where you can really get to scale. So I started the same way a lot of us start, right? I started by investing in single family. I thought, this is the only way to do it. And that multifamily was for people with millions and millions and millions of dollars. And you and I both know that that's not true. And I didn't even know this whole world of passive investing even existed. I had no idea. And so I started in single family too. I wish I would have skipped it and gone straight to multi, but you live and learn a little bit, right? So I graduated from undergrad when I was 20 years old with my degree in finance. And my mom was like, "Great, you'll come work for the family business." And I was like, "Mom, I'm an adult. I am 20 years old. I have a college degree. I'm going to go and do something completely unrelated." And my mom was like, "Okay." And so I worked in corporate real estate for many years. I built a lot of portfolios. I ran a lot of portfolios. I was on the management side for large portfolios. I ultimately left corporate real estate in 2012 and started investing for my husband and myself. And that's when I started buying single family. And then ultimately I ended up saying, I would tell friends what we were doing because my husband's in the medical field. He's not in this space at all. He's a physician. So he doesn't know anything about real estate. And I would tell our friends about it. And then they'd be like, "Okay, well, can you teach me how to do this on the weekends?" And I'm like, "No, busy orthopedic surgeon. You work 100 hours a week and I work 100 hours a week. There's not enough time in a week for you to do this." And then they started saying like, "Okay, well, whenever you invest $100,000, I'll invest $100,000. Let me just write you a check." And I was like, "I don't think you can even do that. I think only like Blackstone can do this, right?" And so that was when I called our securities attorney and I asked him, I said like, "Hey, this is what happened. And I'd like to be able to take these funds and then I can buy more stuff if I have other people's money to work with." And he was like, "Yeah, you can." I was like, "Really?" And he's like, "Yeah." And then, he went over like all the securities rules of 506B, 506C, et cetera. But that was how we started raising capital, was completely unintentional. And that's how we kind of went down this path and then continued to scale. Now we're transacting on pretty large deals. We look at 9-figure deals typically.
That is so interesting. It's not at all unusual that so many real estate investors, even today with all of the podcasts out there, with all of the information out there, are so many people out there who think you have to start with single family because
Yeah.
like you and like me, I was in the same boat. Multifamily is for people who have millions and millions of dollars. So, I mean, it's interesting to me. I've never heard anybody that telling me the same thing, that people were coming to me with money, but I couldn't take it because I didn't know how to do that.
I know how now, but I did not know then.
And I mean, here you had a degree in finance.
Mm-hmm.
And you didn't know anything about 5016 B, and C.
Nope.
I'm not sure what that tells us about our business and administrative departments in our universities.
Yeah, I mean, I tend to agree. I think that I learned a lot of things that were borderline useful, but I think most people that went to college will tell you that they really learn from real world experience, right? And especially in this space, it's such a niche space that if you don't, and they're not going to teach us about T12s and LOIs and rent rolls necessarily, but now that we've done it so many times, we understand it very detail at a very detail oriented level. And sure, like my econ classes that helped me with, pricing and competition and IRRs and NPVs, like all that was great as a foundation, but it was really the experience and just doing it. That's what got us to where we are today.
Yeah. Well, I had an interesting experience as a broker. I had this property listed, and this is in a college town here in Western North Carolina. And they, of course, have a business department there. And this economics professor, and he was not a young man. He'd been teaching economics for years and years and years. He had to have his sister, who was a realtor who lived in New Hampshire, to get in touch with me because he had no clue of even how to purchase a single family property. And he'd been an economics professor his whole life, and
Wow.
he was in his 50s at any rate. And it's
Yeah.
like,
They don't teach basic finance and investments to anybody in college, really. I mean, even in the finance space, they didn't teach me about personal finance or investing. My parents took that burden on.
interesting indeed. Well, thank you for sharing with us how it is that you got started in this process here. For the sake of time here, let's jump ahead here. And you started a fund yourself. You started Vive Funds. Tell us what it is you mean when you're talking about a fund,
Yeah.
and why did you start it, and how did you get it started?
Yeah. So Vive Funds is the name of the owner operator or the company that we operate under. For each individual asset, we actually open a specific direct asset fund for that specific deal. So if I'm buying 123 Main Street, I'll open a fund for 123 Main Street. I also have Rev Fund One, which was launched. It's a $100 million value add equity fund. And the purpose of it was to really answer investor requests to have a way to diversify their capital through one single investment vehicle, which Rev answers. So it's a 5 to 7 asset fund. We're actually getting ready to close up Rev Fund 1 this year with potential of rolling out Rev Fund 2 sometime next year. And so, or, depending when you're listening to it, we might have just closed it and be opening the next one. And so we really launched Rev Fund as an answer to investors' requests. They wanted to have a way to make $100,000 investment, $150,000 investment, and to be auto diversified across assets, which is really the draw of something like a Rev Fund. I had other investors who wanted to have complete control over what they're investing in. They didn't want to be in a semi-blind fund. They wanted to be in a fund where they knew and understood exactly what they were investing into, that they were choosing their project and they could change their commitment amount based on how much cash they have at that time to invest. And so that's why we still ran the other direct syndicated model alongside the fund model.
Okay. So what does it take to actually develop a Rev Fund?
A lot of attorneys, a lot of accountants, maybe even a fund administrator. It is a very complex situation to try to develop a fund, a semi-blind fund. The biggest hurdle to even starting, I think, is if you don't have a track record, it's very tough for investors to just say, yeah, okay, I trust you, right? Because what you're saying is on a direct deal, like a syndicated deal, you're saying, hey, I'm raising money for 123 Main Street. Here's the business plan. Here's what we're going to do, et cetera, et cetera. With a semi-blind fund, you're saying, hey, I'm raising money for multifamily real estate investments. And then with a totally blind fund, you're just saying, hey, I'm raising money, right? And so there's various levels of trust and track record that are required for these. And for us, we knew we were going to be focusing on real estate anyway and value add real estate at that. So that's why Rev Fund is a semi-blind fund, because we already knew the asset class we wanted to be invested in, but it only invests in equity of other deals. And to get started, having that track record is what the tool to be able to, that's going to be the catalyst to be able to raise that capital. Now, there are other ways to get to that track record, right? Like you could find a very experienced partner that you're relying on their resume and their experience. But to truly have a semi-blind fund, you as a sponsor of the fund should really have some amount of track record or experience to be able to overcome the hurdles you'll come across with investors.
Well, how do you go about creating a database to manage all of your investors and everything associated with a real estate project?
Well, don't do what I did, which was initially I was like, oh, I'll just remember everybody I meet. I'm great with names. I'm great with faces. I'm great remembering details, which I was until I met like 400 people at once when I speak at an engagement. It's just not possible. You are just going through so many people and faces and details that you start to get deal merge a little bit even with people, right? So we moved from my memory as being the system, and we went to a very sophisticated Excel spreadsheet as our next move because we bootstrapped the company, right? So I wanted to conserve dollars as much as possible. So I was like, all right, we're going to keep it in an Excel spreadsheet. It's free. It's going to be great. It's easy. Everybody has Excel. Fine. That only works until you get another 100 investors in there. And then it becomes because it's impossible to search. It's impossible to keep updated. It's impossible to keep track of. And so then I moved to a Google form after that, which I was like, all right, now this is like very high tech now. It was not very high tech because it still led to the Google form or the Excel spreadsheet. So now today we utilize investor portals, and that really is a CRM system in the investor portal. We have used MailChimp as a stop in between. So there are plenty of tools out there that are either low cost, but we now use an investor portal dedicated to this type of investor or investment firm. And it really helps us to streamline our capital raise and streamline our communication with our investors, which is really important to us. So if I could go back and do it all over again, I would have invested into the systems and processes out of the gate to keep a good database because, man, it was very challenging. And then every time we had to re-up our investor database, it was a challenge to move it. So I know I thought I was saving a bunch of money. I wasn't. I ended up spending way more than that to get to where we needed to be today.
Yeah, it seems like many of us have to go through that process before we get our head on straight and realize that we need a commercial level database that has the flexibility to expand and at the same time has that flexibility to narrow down to the specificities that you want and need in any customer relationship base there.
Absolutely.
Well, in terms of current trends, and they may be very different by the time this episode comes out, but what are you seeing in the world today in terms of the underwriting trends that we're seeing in terms of interest rates, in terms of cap rates, and so on and so forth?
Oh, gosh. Okay, this is going to be the true test of whether this actually stands the test of time, right? Because we're talking today, if this gets released even a month from now, it could be a completely different situation. So as of now, we are seeing cap rates starting to expand a little bit. We're in very prime locations. Those are our target markets. So our cap rates aren't really expanding at an alarming rate. It's kind of within a reasonable amount that we have already planned for. What's interesting is pricing is not really coming down a whole lot because NOI is increasing at the same clip as cap rate is. And so it is kind of staying in lockstep, meaning that we're still seeing fairly high pricing. The end of 2022 was the best time to be investing in multifamily or just generally real estate from a tax perspective. So we saw a lot of demand from investors, especially large check writers like family offices and private equity groups that needed to place that capital in 2022 versus 2023 when bonus depreciation goes down to 80%. If anybody here is listening and kind of on the edge about whether or not to invest this year in multifamily or not, this year it's 80%, next year it goes to 60%. So you've already missed 100%. You should not miss the 80%. And it's, it's one of those proverbs, right? The best time to plant a tree was 20 years ago. The second best time is today. So I think that we're going to continue seeing a strong demand for multifamily, especially as we are, in the middle of a recession of some sort. And we start seeing interest rates continue. Interest rates, I think, are going to continue to climb, at least for the foreseeable future, until inflation really is kind of at bay. Core inflation has not been coming down at the clip that the Fed was hoping. So I think they're going to continue raising rates. I mean, they've said they're going to continue raising rates. So I'm not some kind of a prophet. I'm just saying, like, this is, Jerome Powell has already told us that this is what's going to happen. So I think that the other reason that multifamily and income producing real estate in general is going to remain to be a strong demand is because it's one of the best hedges you can have to inflation is buying hard assets. And a lot of our investor sentiment through 2022 has been, where else am I going to put my money? I don't have anything that's as stable or as tax efficient or as consistent of a return as real estate is. And so I think we're just going to continue seeing that demand from investors. I do think investor expectations are adjusting. There are no more 20% plus IRRs. We haven't been in that market for a while now. And from an underwriting standpoint, we are leveraging far lower than we've ever leveraged before. As interest rates continue to increase, we are going to leverage lower just to maintain stability throughout the asset and to make sure that we're not putting ourselves into a position where we can't service the debt, because we want to eliminate risk first and foremost.
Preserve the capital above everything else.
Always. That's the first goal.
Well, Veena, tell us, what do you have to offer us and how can we take advantage of it?
Yeah, so I am on social media in everywhere under Veena Jetti. I also recently started a YouTube channel and a Facebook group, and my Facebook group is called Mastering Multifamily with Veena Jetti. It's really intended to be a community of people who love multifamily, whether you're a passive investor, an active investor, doesn't matter. It's for everybody. I do fun things like challenges and math questions, and, we geek out a little bit in there, but would love to have anybody that wants to join there. And in that group, I have a limited number of one-on-one spots where I can speak with people who want to invest either actively or passively one-on-one. I'll answer their questions or whatever they have for me and kind of serve that community that I'm working on creating. So would love to have you guys there.
Wonderful. And we'll have all that information in the show notes. Veena, what advice do you have for the high income earners looking to invest in real estate?
I think if they're already looking to invest in real estate, they're on the right track. Our accountant always says it's not what you make, it's what you keep, right? And real estate is hands down one of the most efficient tools that everybody can take advantage of. And when you're a high income earner, especially if you're an accredited investor, you have so many more opportunities available to you than you even know. I'm married to a physician. We were accredited investors. When we first got married, we were accredited, and nobody told me about this. No one asked me if I wanted to passively invest in something. I had no idea. So if you're listening to this, you already are a little bit ahead of the curve. You already know that this is a possibility. Find a good sponsor, find a good operator, find the asset class that aligns with your personal risk tolerance, and move forward confidently and swiftly, because the longer you wait, the less tax efficient the investment will be.
Excellent advice there. Well, one last question. Veena, what should a new investor be asking the dealer or the sponsor of a syndication or a program that they're investing in?
Yeah. So if you're a passive investor, I always say that the jockey is more important than the horse, right? The horse is great, but you need a really great jockey, because you can have a bad sponsor who can take a great asset and run it into the ground. And you could have a great sponsor who can take a tough asset and make it a solid investment. So you really want to vet and align with the person that you're investing with. You need to know and understand that if you're investing with me, for example, we're in this for the entire life of the project. So if you hate talking to me and you dread calling me, don't invest with me. There's always another deal available. There's another sponsor available. So it's called personal finance because it's personal to you. So find the sponsor that aligns with your risk tolerance. our investors, we are very conservative investors. So if someone comes to me and is like, hey, I want to 2x my money in 3 years, I'm like, thank you so much. This is not going to be a good fit for you because we're not going to put out deals like that. That's not our buy criteria. That's not our buy box. We're going to hit a solid single, maybe a double every now and then. And once in a while, I'm going to hit a home run. And that's how we look at our investments. I would much rather do that than strike out half the time. And so find that sponsor that aligns with your vision, your goal, your personal views and risk tolerance. And then make sure that you understand what you're investing into, how it works. Ask the questions you have. Sponsors are not going to be upset answering those questions. That's what we're there for. We're there to make you feel comfortable and understand. And then once you find a sponsor you like, you only need like 2 or 3 sponsors you really like, and you just keep reinvesting with them. You don't have to go out and reinvent the wheel over and over and over again.
Well, excellent advice. Enlightened investors, thanks for being with us today. I look forward to being with you in our next episode. Veena, what a wonderful time I've had with you today. It has been a wonderful pleasure having you.
Thank you.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.